Hi friends, now we are going to learn about the preferences. First thing, we are starting with the introductions. What is meant by preferences? Companies issue different types of shares to mop up funds from various investors. Before Companies Act 1956, public companies used to issue three type of shares. First one is preference shares, ordinary shares, and deferred shares. The Companies Act 1956 has limited the type of shares to only two, that is preference shares and equity shares. Now we are detailedly learn about the preference shares. Preference shares are those which preferential right to the payment of dividend during the lifetime of the company and preferential right to the return of capital when the company is wound up. Preference shares carry a preference over other shares in terms of dividend payout. Whenever a company announces to pay dividend, preference shareholders get the first payment, so that the preference shareholders get the first priority. They have many preferential rights, so let's find out more about these shares here. And the preference shares or preferred stocks comes with a preferential right when it comes to the distribution of dividends or during the liquidation of a company. It means in both situations, preference shareholders are given more priority than other shareholders. Typically, preference shares are released to raise the capital of the company, which in turn is known as preference share capital. It must be noted that preferred stockholders are partial owners of the company, but unlike common shares, preferred shares do not comes with any voting rights. That's it. Then we are going to the next slide, that is the meaning of a preference shares. The capital raised by issuing preference shares is known as preference share capital, and preference shareholders can be regarded as owners of the company. However, they don't enjoy any kind of voting rights unlike equity shareholders. Preference shares provide the shareholders with a special right to claim dividends during the company lifetime, and also with the option to claim repayment of capital in case of the wind up of the company. If the company is going to shut down, the preference shareholders can take their capital with full amount, that is they can gain the repayment of their capital, they can get the surety for their capital. Then moving on to the next slide, which is the features of preference shares. The following are the features of the preference shares. Preferential dividend option for shareholders. There is always a preferential dividend share option for the shareholders. Preferential shareholders do not have the right to vote. That is one of the worst, I think so. It is the preference shareholders do not have any vote right in the company. They do not have any voting rights in the company. Shareholders have a right to claim the asset in case of wind up of the company. This is the most positive thing, I think so. That is the shareholders can get the right claim in the assets or the wind of the company. But if the company is shutting down, the shareholders can get the asset value which they invested. Fixed dividend payout for shareholders. There is an income from the dividend for the shareholders. The company can allot the dividend according to the profit, irrespective of the profit earned. Act as a source of hybrid financing. The preferences also act as a source of the hybrid financing. Then moving on to the next slide, that is the types of preference. There are a number of types of preference shares. That is the convertible preference share, non-convertible preference share, cumulative preference shares, non-cumulative preference shares, participating preference shares, non-participating preference shares, redeemable preference shares, and irredeemable preference shares. Now we can going to learn about the detail about each type of preference shares. First, starting with the convertible preference shares. Buying stocks always creates the risk of losing money. This is the first thing in the convertible preference shares, but avoiding them altogether in favor of safer investment means missing out of the opportunity for the best profits. There is one type of security, however, that may solve this dilemma for some investors. Convertible preference shares gives the assurance of a fixed rate of return plus the opportunity for capital appreciation. In the convertible preference shares gives the fixed rate of return plus the opportunity for the capital appreciation. Convertible preference shares are fixed income securities. The investor can choose to trade this type of share for a certain number of shares of the company, common stock, either after a predetermined length of time or a specified date, so that the shareholders can share their shares. Okay. The next thing is non-convertible preference shares. In this, totally full is opposite. Non-convertible shareholders cannot convert their shares into equity shares. Regardless, they enjoy the preferential benefit when it comes to acquiring the dividends or during the company dissolution. So they can get the all the benefits while the company is winding up or company is dissolution. They get all the payments, all the assets which they are invested, but they cannot change their shares into equity shares. Then going on to the next type, that is cumulative preference shares. What is cumulative preferences? These shares comes with a provision that entitles shareholders to receive dividends in arrear. So when a company does not make enough profits in a year to pay dividends, they make cumulative dividends in the following year. Suppose a company Star Labs Private Limited, for example, I said, issues cumulative preferences for 1,000 each and promises to pay 10% as dividend annually. Ideally, in a good economy, shareholders would earn rupees 10 on their investment. However, owing to low returns, the company could only pay rupees 10 as a dividend that year. Subsequently, in the next year, the worsening condition, the company could not pay the dividend of rupees 100. Once the profit were generated, the company decided to pay off the current dividend along with the outstanding dividend of rupees 150 to the shareholders. So cumulatively, the company paid rupees 250 as dividend to shareholders. Next, we are moving to the non-cumulative preference shares. And these shares do not have accumulated dividends, because in this share there is no accumulated dividends. It is mostly because non-cumulative preference shareholders are paid from the current year's net profit. So if a company is met with a loss in a particular year, the outstanding dividends cannot be claimed by the shareholders from future profits, because this is the worst thing in the non-cumulative preferences, because that the shareholders cannot claim their outstanding profits in the future profits. If the capital is lost, it is lost. That's it. Then we are moving to the next type, that is participating preference shares. The participating preference shares comes with the shares extend the right to partake in surplus profit during the liquidation once the company in question has paid its other shareholders. So to elaborate, the participating preference shareholders receive a fixed rate of dividend and also have shares in a company's extra earnings. Must individual invest in participating preference shares of those companies which are more likely to generate robust profits. In this, they said that the company shareholders can get the robust profits other than the many of the preference shares. Then moving on to the next, that is non-participating preferences. It is kind of likely opposite to the participating preferences. As the name suggests, participating preference shareholders do not have a share in the extra earnings or surplus assets during the liquidation of a company. This type of share entitles the shareholders to receive only the prefixed dividends, because they can already the amount is to be prefixed in the company, so that the non-participating preference shareholders only get that amount to be claimed at the time of the liquidation of a company. Understand? Then we are going to the redeemable preference shares. These preference shares are also known as callable preferred stock and serve as one of the most effective ways to finance big companies. These shares comes with a blend of equity and debt financing and are readily traded on stock exchanges, because redeemable preference shares are always in the stock market. They are listed in the stock market like NSE, BSE. Typically, a company has the right to repurchase the shares it has issued to the stated its own purpose, because the share market opens daily. These shares are traded in the market with the market value. Typically, a company has the right to repurchase the shares it has issued to the stated its own purpose. Consequently, the redeemable preference shares are repurchased at a fixed date by announcing the same in advance. They can also repurchase the shares by saying in advance. Notably, redeemable preference shares comes in handy for questioning the impact of inflation and decline in the monetary rate, because this share is used to impact of the inflation while the fluctuating of the market. Then moving on to the next topic, that is the non-redeemable preference shares. This thing is all kindly opposite to that. This particular share cannot be redeemed or repaid during the active lifetime of a company, because these shares cannot be redeemed or repaid during the active lifetime of a company. To elaborate, shareholders will have to wait until the company decides to wind up its current operations or liquidate the venture altogether to initiate the same. It makes the shares or preferential liability for the company because this shareholders until decided to wind up its current operations, because the shareholders must be wait to see what the company decision is taking while the company is wind off, or they continue with the profit and losses, so that the next thing only the preferential shareholders can move their idea. Then moving into the advantages of preference shares. There are some of the advantages in the preference shares. That is, the first thing is preference shareholders earn fixed dividends and may also benefits from capital appreciation. Preference shareholders enjoys preference over equity shareholders for dividend payments, because the equity shareholders cannot get dividend payments, but the preference shareholders can get the dividend payments as more what the company is generating a profit, and that a particular percentage they get that as a dividend, so that it is a good advantage. You everything know about the Warren Buffett is the biggest investor. He most of them he invests in preference shares like in Coca-Cola, but today he is getting the $565 million per year, more than that of the CEO's salary of the Coca-Cola. This is the power of the preference shares. Third thing is preference shareholders have the right to claim the company's asset before the equity shareholders, because the preference shareholders always has the first preference value to claim the assets of the company in case of company's liquidation, which makes it as a less risky investment than equity, because preference shares makes less reinvestment than equity shares. Then going on to the disadvantages of preference shares. Yes, if there is advantages, there is a disadvantage also in the preference shares. The main disadvantage of owning preference shares is that investors in these vehicles do not enjoy the same voting rights as common shareholders, because the company shareholders must have voting rights. In this case, the equity shareholders only get the voting rights, and the preference shareholders does not get the equity rights. So that it is very worst things, I think so. And going on to the next point, this means that the company is not beholden to preference shareholders the way is to traditionally equity shareholders, because the company does not depend on the preference shareholders, they depend on the equity shareholders. They will get the suggestion from the equity shareholders and process their ideas. Although the guaranteed return on investment makes up for shortcoming, the interest rates rise, the fixed dividend that once seemed to lubricate the dividend, because the interest rate also increased but the dividend is not increased. This is the worst thing. This could cause the bias remorse with the preference shareholder investors. Higher interest fixed income securities, which get the higher interest in fixed income securities. It's a time to conclude, I think so. These are the things about the preference shares. That is we just recap what are they see is preference shares, introduction, meaning, features of preference shares, types of preference shares, that is convertible, non-convertible, redeemable, irredeemable, participating preference shares, non-participating preference shares, convertible and non-convertible preference shares, advantages of preference shares and disadvantages of preferences. Then with this thing I conclude myself. Thank you for watching my video. Thank you. Hi friends.